There is a public database that most retail investors completely ignore. Every time a corporate insider, a director, a chief executive, a major officer buys shares of their own company on the open market, they are required by law to disclose it. The filing is called a Form 4. It is free. Anyone can read it. And right now that database is showing something worth paying close attention to. 3 companies, all yielding over 11%, have had insiders spending millions of their own dollars buying shares in recent months. Not through compensation plans, not through stock grants, out-of-pocket open market purchases with their own money at current market prices. In this video, we are going to look at all 3. We will break down the business behind each one, what the insider buying actually signals, and what the risks are. Because in every case, there is a reason the stock is where it is. The yield is not the whole story. Understanding why the yield is that high is the only question that actually matters. If you are building an income portfolio and want to follow analysis like this every week, hit subscribe. I post honest breakdowns on high-yield income stocks consistently. And before we get into the 3 names, quick question for the comments. Do you actually track insider buying as part of your research process when evaluating high-yield stocks? Yes, no, or never thought about it? Drop your answer below. I reply to every single comment, and I genuinely want to know how this audience approaches the research. The first stock is Milrose Properties, ticker MRP. Milrose completed its spin-off from Lennar Corporation in February 2025, and it does something genuinely new in the REIT world. It is the first publicly traded land banking REIT in the history of the U.S. market. The model is straightforward to understand once you see it. A home builder comes to Milrose and says they want to build homes on a specific piece of land, but they would rather not tie up their capital purchasing the lots right now. Milrose buys the land. The builder pays a non-refundable deposit plus a monthly option fee and agrees to purchase the finished lots at a predetermined price at a later date. That non-refundable structure is critical. It disincentivizes builders from simply walking away when market conditions get difficult, which protects Milrose's income stream. When the lots are eventually sold, Milrose collects 100% of the proceeds and immediately recycles them into acquiring more land. The cycle repeats. As of their full year 2025 results, Milrose owns around 142,000 home sites across 933 communities in 30 states. California, Texas, and Florida account for roughly half the portfolio. The total portfolio of home site option contracts is valued at approximately $9.2 billion. The stock currently yields around 11%. Now the insider story, and this one is striking in a way that is hard to dismiss. On May 11th of 2026, CEO and President Darren Richmond purchased 235,000 shares in the open market, for a total of approximately $6.4 million out of his own pocket. At the same time, the COO and General Counsel also made open market purchases. When a CEO spends $6.4 million of their own money buying their own stock at current market prices, that is a very specific and very expensive statement of conviction. There is an important caveat about the dividend that you need to understand before buying. Milrose pays out 100% of their adjusted funds from operations after fees. That means the dividend is variable. It rises when business is strong, and it can fall when activity slows. In 2025, their first full year of existence, they reported AFO of $2.58 per share and a full-year dividend of $1.80 per share. Quarterly dividends grew from 38 cents to 69 cents to 73 cents to 75 cents through the year. The direction has been upward, but there are no guarantees, and this is not a fixed payment like many other REITs. The macro context also works in Milrose's favor. Home builders want to go asset light. They want to build homes without tying up capital in raw land purchases. That trend is accelerating as balance sheet discipline becomes more important across the sector. As of year-end 2025, Milrose had grown its relationships to 15 distinct builder partners, including 9 of the top 25 national home builders. It is a young company in an untested structure. You are watching it build its track record in real time. But the CEO just voted with $6.4 million of his own money that he believes in what he is building. The second stock is Hercules Capital, ticker HTGC. Hercules Capital is a business development company, a BDC. These companies lend money primarily to growth stage businesses, particularly in technology and life sciences, and pass the income through to shareholders. The BDC space has been under pressure. As interest rates fell, many BDCs saw net investment income compress, and dividend cuts followed across the sector. Hercules held its base dividend steady. The company generated record total investment income of $532.5 million in 2025. Non-accruals, loans that are essentially non-performing, sit at just 0.1% of the portfolio at fair value. Dividend coverage sits at approximately 120%, meaning they earn roughly $120 for every $100 they pay out. By the numbers, the underlying business is performing well, and yet the stock fell hard. On February 27th of 2026, a short-selling research firm called Hunterbrook Media published a report titled The Myth of Hercules. The report made a series of serious allegations that Hercules' deal sourcing was essentially copying investments already published on Google Ventures' website, that a four-person valuation team was understaffed with inadequate oversight, and that software debt was being misclassified and marked at 100 cents on the dollar despite industry-wide distress in software lending. The stock dropped 7.9% in a single session on unusually heavy volume. Here is where the insider signal becomes relevant. Following that sell-off, board members and C-suite executives collectively purchased close to $1.9 million worth of HTGC shares. These are people who have access to the actual loan files. They know every borrower. They have seen the valuation process from the inside. And they responded to a short seller's allegations by opening their own wallets. That said, the situation is more complicated than it was a year ago. The Hunterbrook report has since triggered a securities class action lawsuit covering investors who purchased HTGC between May 1st of 2025 and February 27th of 2026. The allegations are serious. Misclassified software debt, understated non-accruals, inadequate valuation checks on a $5.7 billion portfolio. Hercules has not been found liable for anything. The lawsuit is active. But this is no longer just a short report. It is a live legal proceeding that adds real uncertainty. One more point worth noting. Some financial platforms have shown Hercules' dividend history inaccurately, displaying apparent cuts that never actually happened. Always verify directly on the company's investor relations page before drawing any conclusions about their dividend track record. Most recent Q1 2026 earnings showed record new commitments of $1.81 billion, and that 0.1% non-accrual rate held steady through the turbulence. The underlying business by the numbers continues to perform, but the legal overhang is real and needs to be priced into your decision. The third stock is Soundpoint Meridian Capital, ticker SPMC. This is the most complex and the most speculative of the three. Soundpoint Meridian Capital is a closed-end fund that invests primarily in the equity and mezzanine tranches of collateralized loan obligations, CLOs. These are structured credit vehicles backed by large pools of below-investment-grade senior secured loans to U.S. companies. The current yield is approximately 26%. That number requires serious context before you do anything with it. CLO equity tranches sit at the very bottom of the capital structure. They absorb losses first. In exchange for bearing the highest risk, they receive the residual income. After all senior tranches have been paid, when credit markets function well, that residual income can be extraordinary. When credit conditions deteriorate, principal loss is very real. The stock has fallen sharply from a 52-week high of around $21 down to approximately $9 to $10 as of early 2026. That collapse in price is why the yield looks so high. A 26% yield on a $9 stock is a fundamentally different situation from a 26% yield on a $21 stock. There have been dividend reductions. The monthly payout has been stepped down from earlier levels. The company was founded in 2022, so the track record is limited. The insider buying here is worth being precise about. The most meaningful purchases were modest. A director bought approximately 2,000 shares at $11.50 in February 2026. For around $23,000, and the chairman made purchases in the range of 8,000 shares. This is not the same order of magnitude as Milrose or Hercules. Worth noting, but not in the same category as a CEO deploying $6.4 million. If credit conditions stabilize and spreads tighten, SPMC's income could recover meaningfully. If credit conditions stabilize and spreads tighten, SPMC's income could recover meaningfully. If credit weakens further, the NAV continues to erode. This is a high-conviction bet on the credit cycle, not a passive income hold for someone who wants predictability. Here is the broader framework that ties all three together. There is a version of income investing that is just chasing the highest number on a yield screen. And there is a version that tries to understand why the yield is that high and who else thinks the stock is mispriced. Insider buying does not answer that question for you, but it asks that question in the most expensive possible way with real capital at real risk. The CEO of Milrose put up $6.4 million of his own money. The Hercules C-suite collectively bought $1.9 million after a 7.9% single-day crash. Those are decisions worth understanding deeply before you decide whether to follow them. None of these are automatic buys because insiders purchased. Every one of them has a real reason it is where it is. But the Form 4 database is public, it is free, and most retail investors scroll right past it. That gap between what is available and what most people actually use is where conviction opportunities tend to hide. Now, the question I want in the comments: do you hold any of these three? Or is there a high-yielding stock with heavy insider activity you think deserves a closer look right now? Name it and tell me why. I read every single comment and I will reply. Hit subscribe for weekly breakdowns like this. Let us build something real.